Buying the right stocks at the right time can give you the ability to beat the market over the long term. That's why today we'll be talking about the top 6 best high growth stocks to buy in July 2021, and we're starting right now. The first stock on our list is a disruptor in the telehealth space, and that is Teladoc, ticker TDOC. This stock rocketed up during the pandemic for obvious reasons. Doctors were forced to see patients out of the office. Teladoc provides a bunch of 24/7 healthcare services from telehealth, medical opinion, and AI analytics, all on a virtual platform. So it's not a surprise that it hit an all-time high of $308 a share during the pandemic, but it now hovers around $165 a share, making it an interesting time to take a look at buying up some shares. Let's dive into the risks first. The first concern is that the company has not achieved profitability yet, and it has been around almost 20 years. Although this isn't uncommon in high growth tech stocks, it is still something to pay attention to. On the bright side of this risk, they have been steadily improving their net profit margin over time. Another concern cited by analysts is the fact that the company was served up a perfect situation for its business during COVID. It still remains to be seen if they can prove their business can grow at the same rate after the pandemic. There will also be additional competition in the coming years within the telehealth space. But looking back before the pandemic, their growth trend was still very strong, increasing sales on an average of 72% year over year the 6 years leading up to the pandemic. Even though there are risks, there are a ton of reasons to be bullish on Teladoc. First, they are playing in a massive telehealth market that is projected to grow over $550 billion by 2027. This means there is plenty of room for multiple players in the space, but if Teladoc is able to capture majority market share, it would mean incredible growth in the long term. To boost their ability to capture this market share, they recently acquired another leader in the telehealth space, Livongo, for $18 billion in 2020. Livongo offers telemedicine solutions catered towards diabetes and heart disease patients. This acquisition seems to already be paying off for Teladoc. They reported in their Q1 earnings report that the number of customers using Livongo's products was up 66% year over year. Teladoc as a whole doubled its revenue from $550 million to over $1 billion from 2019 to 2020 and is projected to do over $2.2 billion in revenue in 2021. The median analyst price target is $231.26 a share, representing a 41% upside from its current levels. The stock is down over 19% since last July and down almost 50% since February, meaning it could be a good time to add Teladoc to your portfolio. The next one is an e-commerce juggernaut in the Chinese market, and that is JD.com, ticker symbol JD. This one has flown under the radar for quite a while, but famous growth investor Cathie Wood recently sold shares of other Chinese growth companies to increase her position in JD.com back in June. JD.com is often compared to Alibaba, but what many may not know is that JD recently passed Alibaba to become the largest e-commerce and internet company in China by revenue. Its fulfillment centers span 99% of the country, which allows them to provide same day and next day delivery for a majority of their orders. The first obvious risk to JD is the fact that it is based in China. Historically, communist governments haven't been a great environment for businesses to thrive, and theoretically, the Communist Party of China could implement law that hinder JD's growth whenever they wanted. Of course, as companies like JD and Alibaba continue to grow and extend their influence, it'd be more difficult, but it is always a possibility. We also do not know the future of the US-China relationship. If a trade war were to begin, like we almost saw under Trump, that would significantly impact the company as well. Despite these looming risks, JD is in a position to keep growing and fast. China is the world's most populated country, meaning more potential customers. Over 460 million people in China shop on e-commerce platforms. That's nearly 1.5 times the population of the United States. And this just keeps climbing, meaning more customers for JD.com. Unlike Alibaba, the company has its own logistics network with warehouses they own, meaning they have more control over the business model and take home more profit on average than Alibaba. Revenue jumped 29% last year to $114 billion, and the company claims to have 500 million annual active customers. They are projecting revenue to grow by 28% in 2021. At $75 a share, it is also a lot more affordable than Alibaba, but actually produces more revenue. Analysts have taken this all into account with a median price target of $101.33 per share, implying an upside of 33%. Out of 15 analysts, 14 currently have a buy rating on the stock, given that it has fallen 30% from its all-time high in February. Now could be a good time to add JD to your portfolio. The next stock on our list plays in the biotech space and has the highest implied upside according to analysts, and that is Sarepta Therapeutics, ticker CRPT. Sarepta is a major drug producer whose main aim is to treat something called Duchenne muscular dystrophy, which is most popular in kids and causes their muscle tissue to degrade at an early age. There's no doubt that this is an important drug, but there are some risks that come along with Sarepta. The first would obviously be the fact that they get all of their revenue from 3 drugs. To increase revenue substantially, they will have to produce more FDA-approved drugs. This means a lot of money and time spent with no guarantees that their drug gets approved. They're currently running experiments on a drug called CRP-9001. The stock has spiked downward on bad news of the evaluation in January. The drug showed promising signs, but they were not statistically significant. So the downside here is that you are somewhat dependent on Sarepta's ability to secure FDA approval if you want the stock to break out. On the bright side, it's clear that there is a ton of demand for the types of drugs that Sarepta produces, and they have proven they can achieve FDA approval multiple times. There's also been a lot of news recently indicating that their CRP-9001 drug candidate has improved significantly since their negative report in January. And despite relying on 3 drugs, the company has grown its revenue by 79% from $301 million to $540 million between 2018 and 2020. Despite being a more risky investment, analysts love this stock, showing a median price target of $116.13 per share, implying an upside of 55%, while the high price target of $166 per share implies a 145% upside. Sarepta is almost down 60% from its all-time high in January, which could mean it might be a good time to scoop a few shares, but I would definitely do your own due diligence and evaluate the risks on this one. The next stock on the list is a fintech heavyweight, StoneCo, ticker STNE. This company is a dominant force in the South American payments market that is often compared to Square in terms of their business model. The legend himself, Warren Buffett, bought up to 8% of the company in its IPO day back in 2018 and now holds almost 12% of the company. The Brazilian-based company offers solutions for point of sale, payment processing, and management tools for small and medium-sized businesses. They focus on providing similar services to companies like PayPal and Square, but focusing on the South American markets. Before we get into what makes Stone an interesting investment, let's address the risks. Stone had much less competition at the time of its IPO, but now companies like PagSeguro Digital, ticker PAGS, and PayPal are breaking into the Brazilian payment space. This means that it will be more difficult for Stone to continuously increase its market share year over year. Another important risk to consider is that Stone will also be impacted by the health of the Brazilian economy overall. Last year, Brazil's GDP grew at half the rate of the United States, and although Brazil's economy is strong relative to the rest of the world, it is not nearly as stable as places like the United States and the United Kingdom. Although there are quite a few risks with the stock, there are a number of positive trends that play in Stone's favor. Despite multiple competitors breaking into the space, they have been able to double their market share over the last year to 14%, indicating that there's a strong stance against its competitors. Despite the Brazilian economy being less stable, they are the largest e-commerce market in Latin America and the 4th largest internet market in the world, meaning there are a lot of online transactions to be processed, putting Stone in a great spot to benefit from this upward trend. Stone has been quickly moving to position itself to gain even more market share. They recently acquired a company called Lynx, which is the leader in retail payment software in Brazil, with over 45% market share. This acquisition opens up a ton of immediate growth opportunities for Stone. Analysts have a medium price target of $84.76 a share, representing a 25% upside. With Stone stock down 23% year to date, July could be a timely opportunity for long-term investors to add this growth stock to their portfolios. Up next is another player in the financial space, Upstart, ticker UPST. This is an exciting fintech company well positioned to disrupt an entire financial services industry. Upstart offers an AI lending platform designed to improve access to affordable credit while reducing risk for lenders. They provide personal loans based on non-traditional variables like education and employment to predict credit worthiness and make the loan as successful as possible for both the banks and their customers who are receiving the loans. The entire process occurs in minutes over an easy-to-use digital platform. The company was founded by 2 ex-Google executives and it has been on a roll. The founders are still highly involved in the day-to-day and still have 17% stake in the company. In other words, they have major skin in the game, meaning they will be focusing on doing everything they can to increase the value of the stock. Let's talk risks with Upstart first. There are some other well-funded competitors in their market. Companies like SoFi and Float offer similar services, however, their predictive models and risk analysis are currently not at the level of Upstart's. But that does not mean that those companies won't catch up. The other main issue is that Upstart currently gets 60% of its revenue from one client, Cross River Bank. And although that number has fallen from 79% last year at this time, there isn't any evidence to suggest this client is at risk right now, but there is certainly risk in having that large of a percentage of your revenue coming from one client. Getting to the good stuff, Upstart is sitting in a market with huge long-term opportunity. Right now, the unsecured personal loan market totals $92 billion in value, and Upstart has stated that they believe they control about 5% of this market currently. They recently added auto loans to their offerings, which would bring their total addressable market to $3.4 trillion. Now that is quite a runway. After their IPO in mid-December, it has almost tripled to $124 a share. Now you might be thinking,
Alex, this stock is way too pricey right now.
And technically you'd be right to think that since the PE ratio is rather high. But even though the stock has skyrocketed over the last 6 months, analysts are still calling for an upside of 16% in the short term, with the company already showing profitability and posting 90% year-over-year growth in revenue last quarter. Upstart is in a strong position to keep growing into the future. The stock recently slid 20% over the past month, which could give long-term investors an opportune time to scoop up a market leader in a booming industry. The final stock on the list is a major player in the e-gaming industry, and that is Skillz, ticker SKLZ. Trading around $20 makes it the most affordable stock, yet most risky on my list, and you'll see why. Skillz is an online mobile multiplayer video game competition platform. It provides a number of integrations with iOS and Android games, and the company is an interesting business model that isn't as common in the e-gaming industry. Its platform allows for gamers to compete for cash prizes. Skillz, along with the developers of that game, get a cut of the cash prizes. This tremendously reduces their risk and contributes to their insane 95% profit margin. Let's dive into a few concerns around Skillz. The first risk to take into account is the fact that currently 88% of their revenue is coming from their 3 most popular online games. This obviously leaves them vulnerable in the short term and increases the pressure to find other more popular games to promote on their platform. The company also gives 50% of its revenue to the developers of the games that they offer on the platform, meaning that they will have to produce substantial volume to lead to meaningful revenue growth. Skillz is also responsible for doing all of its own advertising. Mobile gaming ads are known to be full of empty promises, meaning that Skillz will need to make sure that they are not alienating or confusing potential users and gamers. Even though Skillz faces significant risks, it also benefits from being in a booming industry. The mobile gaming industry is currently worth almost $80 billion and growing fast. Even capturing a small fraction of the market would mean incredible growth for the company. Skillz recently signed a multi-year agreement with the NFL to bring NFL-themed games to their platform in late 2021, early 2022. Football is by far and away the most popular sport in the US, and this represents a great opportunity for Skillz to bring additional users to their platform. And Skillz says that they already have about 70% of their users paying, which is over 8 times the industry average. If this trend continues, their sales are projected to triple by 2024. The median analyst price target is $24.50 a share, implying 21% upside, and a high price target of $34.50 a share, implying a 60% upside. The stock has gotten hammered since February, dropping 56% from concerns over overvaluation, coming from its high of $46.30. So as long as you take into account the risks, this could be a great stock to add to your portfolio. Thank you so much for sticking with me until the end. Can't tell you how much I appreciate that. Let me know in the comments below if there are any other stocks you would add to the list. And if you're interested in learning more about investments, check out this video on the 3 best investments to profit from inflation. Click on that and I'll see you over there.